Okay. Good morning, everyone. I want to welcome you to a new week. But before I get started today, I want to make this announcement. I'm going to first start by saying I'm not happy today. You know why? Because if you compare the number of students that are presently attending this lecture compared to those who wrote exam last Friday, you're actually going to see there is a statistical significant difference. I'm going to appeal to you. Uh, Even though in the syllabus, there's no penalty for missing lecture, but I will encourage you to be very punctual because uh, I know this very course may look kind of tough, but if you attend my lecture and you ask question when you get stuck, you actually going to be fine. I don't want situation where somebody's going to struggle in the final. Final has a huge weight. We are currently counting down to the final. Of course, I will release my final exam practice question next week. So please, if you have friends that are not around right now, encourage them to attend lecture. Okay, the final announcement. I've decided to stop assignment. There's not going to be any new assignment for the remainder of the semester because you know why? Because I wanted to focus on the project. Okay. Today, I'm going to assign groups to topics they're going to work on, the areas they're going to work on. And for those who have not secured group, I will automatically, assign them to group. Or what I advise you to do is keep track of what is going to be going around in the announcement section. I want to welcome you once again to this topic. Those of you at the back, can you hear me clearly? Thank you so much. I want to walk you into what I call portfolio theory with covariance analysis. Let me tell you this. Uh, this area is very, very practical. Um, we actually want to further exploit the use of covariance. Let me say this. If you are interested in how variables move together or how they move apart, if you want to have a measure of that, of course, you need to conduct analysis of covariance. So the covariance, if you get a covariance matrix, okay, you're actually going to have opportunity to see the variation within the variable, and at the same time, you're actually going to see the covariation. But we want to apply this in financial, theory that we call portfolio theory. Okay. Now, let me tell you the bottom line. In portfolio theory, uh, you know, they are trying to look into how we can mix assets, okay, in a way that we're actually going to minimize what I call the risk of the portfolio. If I want to have a measure of the risk associated with portfolio, I actually need the covariance analysis because the covariance will enable me to know the risk associated with each asset. And not only that, two or more assets may vary together, or all of that can be captured by way of covariance analysis. So when I say portfolio theory with covariance analysis, then it means what I actually want to do, we want to provide a strategy for investors to diversify, to spread their investment across different assets. How are they going to do that? The way they're going to do that, for them to be able to have a very excellent diversification is when the assets don't correlate, because when assets move together, the risk is going to be high. It means when these assets perform poorly and and that move with the other asset, then the other asset is also going to perform poorly. We don't want that kind of situation. So the portfolio theory will enable us to have a strategy to optimize uh, the risk. That is, how can I minimize the risk given the expected return from asset? Of course, from each asset you are expecting return. Okay, how can we minimize the risk? Okay, given a particular expected return, or in another way, we can say, how can we actually maximize expected return given a particular risk? So if I want to talk about risk analysis, then I need a covariance. And that is why we're doing what we're doing now. Okay. Now, like I said, the portfolio, we're going to talk, since we have a portfolio, that we built, portfolio, like I said, is a linear combination of different assets. We don't want you to put all your money in one asset. We want you to put your money in different assets with the belief that the portfolio theory that you apply will enable you to minimize the risk associated with that. So because of that, we're going to talk about mean variance portfolio theory, okay? Because the variance of portfolio is the risk associated with the portfolio. Then we also want to talk about the mean, which is the expected return. Then we're also going to talk about correlation as well. Please, I need you to pay attention. Let me tell you this. Why do I put resources? Why do I invest into different assets? Because I'm actually anticipating expected gain. Expected gain is return, expected return. Okay. And how can I do it in a way that I will be able to minimize the risk of the portfolio, given the expected return? Then the portfolio theory will give us a mathematical way of doing that. Because of that, we want to focus on the mean variance portfolio theory. Now that you understand what we try to do by portfolio, a well-constructed portfolio, is the one where the assets has a negative correlation. Because if they have a positive correlation, if a particular asset perform poorly, the other asset will also perform poorly. You don't want that. And that is why you want an excellent diversification. Okay, so for you now to understand the portfolio theory that has to do with the mean and variance, okay, I'm actually going to go statistical. Please pay attention. If you don't understand, ask me a question. Suppose, we have a collection. Give me 1 second. Let me see. Let me see this. Okay, suppose you have a collection of assets, okay, and you want to form a portfolio. Forming a portfolio, you need to decide how much money do I need to invest in each asset. The money you are investing in each asset is going to be called weight. Weight. Okay. Now, assets here become random variable like X1, X2, up to XP. Okay. In case you have a P number of assets. Okay. Now, I said, we can make decision on that very the feasibility of maximizing expected return or minimizing the risk, by analyzing the mean and the variance. So mean and variance of portfolio is very, very crucial, okay, for you to put forward what I call a well-formulated portfolio. Now, I said, for instance, forming a portfolio that minimizes the variance of the portfolio. So let me tell you, our intention is we want to minimize the risk. The variance of the portfolio is the risk associated with our portfolio. Can I have a way to minimize that? Giving a particular expected return? Or another way I can put that, can I have a way to maximize expected return given a particular risk? Okay, and that is exactly what we're trying to talk about. And I said here, the variance of the portfolio depend on the variance. Let me tell you this. The variance is just like in statistical theory, you're talking about the variance of a linear combination of random variable. A random variable, if I have a linear combination of a random variable, a function of a random variable is also a random variable. So the variance of the portfolio actually depends on the variance of each asset, not only the variance of each asset, but also depend on the correlation between them. Does that make sense? I'm going to say that again. The variance of a portfolio that we call the risk of the portfolio depends on the variance of each asset. Every asset has its own risk. I'm actually going to call that individual risk that we also call unsystematic risk. At times they call it a idiosyncratic risk or unsystematic risk. And not only that, it also depends on the correlation among these assets. Okay, so that's exactly what I mean. And let me tell you this: the approach, to be able to, the strategy that is actually going to work for you to be able to form a well-formulated portfolio was put forward by Markowitz. Okay, Markowitz. Markowitz put forward what I call mean variance portfolio theory. Why the mean? Why the variance? The mean is the expected return, which is a gain from the investment. The variance of the portfolio is the risk associated with the portfolio. And the risk of a portfolio, which is the variance of a portfolio, depend on the individual risk and the correlation, okay, between the assets, okay, and that is because of the fact that we want to understand the mean of the portfolio, the variance of the portfolio, and of course the portfolio is a linear combination of a random variable. Then we need to go statistical, trying to have a recap on linear combination of a random variable, okay, and of course we're going to do what I call some kind of optimization as well. Okay, now take a look at this. I want to go statistical now. We don't just do what we do. We got reason why we do what we do. Now, you know what I want to do right now? I actually want to believe that the portfolio that I want to believe that I have uh, asset X1, X2 up to Xn. So this is trying to say, oh, I have a number of assets that I'm investing my money on. Investors invest money on more than one asset. And the reason for doing that, if one asset perform poorly or one company perform poorly, it's actually going to rely on the performance of the other assets. But provided the assets don't correlate. What if in a situation where assets correlate? That's dangerous. And that's why a very excellent portfolio is the one where the assets are they have a negative correlation. When assets have negative correlation, that's a very good that's an excellent portfolio. Okay, and let me tell you this: the optimal, if you want to consider the asset, you consider stock, you consider bond, you consider security. Okay, stock or bonds and security. Okay, when you put your money into all of that, or you have a linear combination of all of that, that is not going to be risky. Okay, That's exactly what I mean. Now take a look at this. Okay, x1, x2 up to xn, they are random variable. We're trying to say the assets are random variable. Yeah, they are random variable, and that's why each of them has their variance. And at the same time, there's possibility of moving together. Okay, and we have this in n-dimensional. Okay, depending on the number of assets you want to put your money on. Okay, now take a look at this. For example, if SK denotes the return of asset K, let me tell you this, on each asset, okay, you expecting return on each asset. That's what I mean. Okay, now, and I said here, I said then S model the returns of an asset jointly, taking into account any dependence between the return of the asset, because when assets correlate, the returns from asset also correlate. So in building portfolio, we normally are going to put into consideration the the way the assets are vary together. Okay, and let me tell you this. And also I said something here. I said most probability concept extend in the obvious way from the univariate setting into multivariate setting. Of course, this is going to be a multivariate setting because I'm having more than one variable that varies together. In that situation, instead of me considering a univariate means measurement based on one variable, I'm not going to talk about one asset this time around. I'm talking about many assets, and of course, that will be multivariate situation. And situation where there's a multivariate, of course, there's going to be a consign with the moving together. Whenever they move together or they move apart, of course, correlation is involved. When covariance is involved, the correlation will be involved. Now, you know what we want to do now? Because we know that variance, okay, the covariance, the correlation, all of that will be involved. I'm actually going to go statistical. Now, take a look at this. I want to have a recap of something you've done before, something you've done before in a lower level statistics. Okay, let us have a definition for covariance. Let's have a definition. Let's have a statistical definition for covariance as well. Okay, when I talk about covariance, of course, the covariance is, is just definition. And, covariance, alternatively, I can say the expectation of a product minus the product of the marginal expectation. Okay, the expectation of a product minus the product of marginal expectation, that is a covariance. This is a situation where I'm having S and Y. Maybe I'm having two assets, asset X and asset Y, and I want to see whether they move together or they move apart. If I want to investigate that, I'm actually going to find the covariance. And when I standardize my covariance, I get my correlation, because why do I need to standardize my covariance at times? I don't want a situation where a particular variable will dominate the other. And that's why we standardize our covariance to get a correlation. Okay, now, you need to revisit how you interpret covariance and how you interpret correlation. Of course, correlation go from -1 to 1. Okay, when it's 1, that's a perfect positive correlation. When it is -1, that's a perfect negative correlation. When it is very close to 1, you have a strong positive. When it's very close to 0, of course, you have a weak positive, and so on like that. So this is just to remind you of what you have done before. Okay, and of course, when the covariance equal to 0, of course, automatically correlation will also be 0, because if you come back to the formula, take a look at that. The correlation between S and Y is the ratio of the covariance to the square root of the product of the variance of S and the variance of Y. The moment your numerator is 0, of course, the correlation will also be 0. And that is what investors, that is what they want. They don't want situation where two assets, they're actually going to correlate. They don't want that. So that's exactly what we mean. Okay, now, because we're going to be in portfolio analysis, uh, We need the idea of a linear combination. Don't forget, in portfolio analysis, we're talking about the linear combination of the assets and the amount you put into each asset. I'm going to say that again. The linear combination of different assets, and of course, the weight of each asset is the amount of money you invested into a particular asset. Okay. Because of that, because we actually going to be working on linear combination, then we need to revisit that in statistics. We need to be able to understand how we deal with a linear combination. And whenever we're talking about a linear combination, of course, we're going to talk about the covariance and the correlation. So let's talk about the properties of covariance first. If I have X, Y, and Z, maybe I got three assets: asset X, asset Y, and asset Z. Okay. And of course, in the properties, if two assets vary together, okay, if you take a look at number one, you know what that guy is telling me? The covariance of XY is the same thing as covariance of YS. This is like commutativity, okay? The covariance of XY is the same thing as the covariance of YS, okay? If you take a look at the second one, if A is a constant, please pay attention. If A is a constant and S is a random variable, of course, the covariance between a constant and a random variable is expected to be zero, because constants don't vary. Constants remain the same. A here is acting as a constant. Okay, so this is a way of trying to, you to have a recap on statistical theory of covariance. Okay, now let me tell you this. If you take a look at number three, you know what this guy is talking about? The covariance between X and X. Of course, that would be variance, because I'm talking about the same variable. So the covariance of X and S is the same thing as the variance of S. It's like I'm talking about a particular asset X. Okay, now I need you to pay attention. The covariance between a linear combination and a Z. Okay, maybe here I have two assets. I spend A and B. I spend A on asset X. I spend B on asset Y. Okay, and maybe I actually spend maybe $1 on asset Z, and I want to look at the correlation between a linear combination of AS and BY and a Z. Okay, so this is a statistical way of writing that. Okay, this guy equal to that. Okay, it's going to be A covariance SZ plus B covariance YZ. So pay attention to that. And situation where X and Y are not independent, please pay attention. Where X and Y are not independent, X and Y not independent mean X and Y actually they are connected. If X and Y are connected, the variance of X plus Y is the same thing as the variance of S, the variance of Y plus 2 covariance XY. But situation where S and Y are independent, the covariance is going to be equal to 0. When the covariance is equal to 0, you're only going to have the variance of S plus Y equal variance of S plus variance of Y. But here, I'm trying to tell the world that, okay, they move together. And that's why I'm actually including the covariance. Let me tell you this. If you want to understand the mathematical rationale behind portfolio theory, you need to understand the properties of covariance that I just explained to you now. Okay. Now, if I want to move beyond, please pay attention. And we're getting there now. If I want to move beyond X and Y, if I want to go from X1, X2 up to Xn, if I have n number of assets, I have asset X1. Okay, what is the amount of money did I invest on asset X1? A1. What is the amount of money that I invest on asset X2? A2. What is the amount of money that I invested on asset X3? A3. Dot until I get to what is the amount of money that I invested on asset XN? AN. Now, if I now want to know the variance now, don't forget the variance. What do you think I'm looking for the variance? The variance of a linear combination, okay? If this is a linear combination of assets, the variance of a linear combination is actually the risk. If I want to have a measure of a risk of a portfolio, I need to find the variance of a linear combination. We don't just do what we do, okay? What dictates, to whatever we're doing in statistics, in machine learning, the data science, of course, is mathematics. We use mathematical theory. Okay, now in the variance, I'm actually going to have you take a look at this. This guy now can be written as that. So which means I'm actually going to have the individual variation. I'm going to have the variance of S, the variance of X1, the variance of S2, the variance of S3, up to the variance of Xn. I'm also going to have possible covariances among them. That will be a lot. Okay, there's going to be variation within the assets. There's also going to be covariation, variation between any pair of assets. Okay, that's exactly what I mean here. Okay, now how do we obtain correlation from sample? Of course, in research, we're limited by budget. We don't study the entire population. We take a sample. And if I want to have a measurement, if I want to talk about the covariance, of course, I need to have a way to estimate that from the sample. Let me start from how do I get a sample mean? Of course, how we get a sample mean is just the summation of S divided by N. Okay, how do I get the variance? This is the variance for within S, and this is the sample covariance, and this is the sample correlation. These are just the formula. If I have my data set, okay, how do I estimate, the mean? How do I estimate the variance, and how do I estimate the covariance? That's exactly what I mean. But you know what? This is when I'm focusing on the covariance here, is just talking about when I have two variables. I may not necessarily have two variables because I'm actually going to have more than two assets. Also, because of that, I'm expecting to have a covariance. Oh my God. Can you see what I have right now? Why am I having covariance matrix? I'm having covariance matrix because I'm actually going to have a good number of assets. Each of them, we have their variances, and there's also going to be a covariance. If you take a look at, if I have S1 up to Xn, and they're actually the assets. Asset X1, asset X2 up to Xn. Okay, what is the covariance? The covariance X is going to be, if you look at the diagonal will contain the variances, which is what we call individual risk. The risk associated with a particular asset of diagonal will be the covariance of diagonal will give you how the asset varies together. Am I making point? You are getting that, right? Okay. Now, so that is what I'm trying to say here. So here, I'm actually going to have a lot of sigma ij. I'm actually going to have a lot of covariances. Okay. Now, depending on the number of features that I have, now I needed to pay attention what we're reviewing today, what we're looking into today is to look into the statistical foundation or the mathematical foundation of covariance, because we actually want to use covariance in portfolio theory. Just like what I used to tell some students, I said, if you want to understand statistics, probably you need to be mathematically inclined, okay, to be able to do that. Now let's talk about the properties of covariance matrix. If I have a covariance matrix, okay, because I want to be sure my covariance matrix is valid. You remember what we did in the last topic, where we actually brought in the idea of a lasso penalty into graphical structure, maybe because I got a lot of features and the number of features is actually greater than the number of observation. I expect covariance to be unstable. Okay, when covariance is unstable, then it means it is not valid. Okay, how are we actually going to know the covariance that we have is valid? And that is why we want to do this. We want to talk about the characteristics of a covariance matrix, because in a portfolio theory, we make use of a covariance matrix. And how do I know the covariance matrix that I've already put in place is actually valid? Okay, the only way to know, it has to be symmetric. Symmetric in the sense that when I have a covariance and I take the transpose of the covariance, it should be the same as the original one. That's what I mean by symmetric. Okay, and not only that, we expect it to be positive semi-definite. Please pay attention. What do I mean by positive semi-definite? There's a difference between positive definite, positive semi-definite. The positive definite means in the diagonal of the covariance matrix, they should be greater than zero. Don't forget, what do we have in the diagonal of a covariance matrix? We have the variances. Okay, now positive definite means they should be greater than zero. Semi-positive definite mean they should be non-negative. They can be zero or greater than zero. That is what the semi is talking about. Okay, so when I have a covariance matrix, the diagonal element should be greater or equal to zero. That's exactly what I mean. And of course, it should be symmetric, and it should satisfy that. Okay, so that is the properties. Then I actually want to move. Now we have reviewed mathematical and statistical theory associated with the covariance matrix. Okay, because why are we doing that? We are actually doing that because of the significance of covariance matrix in portfolio theory. We want to apply that to portfolio theory. We need to first have a recap on the statistical or mathematical properties of the covariance matrix. That's what we just did. But you know what I want to do now? We want to leave statistics now. We want to go into financial, the financial aspect of that. We want to understand asset returns. Don't forget, when I say asset returns, when I actually invest on different assets, okay, we are all investing with expectation that there's going to be a return. Nobody want to throw money away. No investor want to throw money away. Okay, they always have something in mind. Okay, so which we call the asset returns. Okay, well, let me tell you this. We have asset returns, or we have different kind of asset returns. Okay, we have the logarithmic returns, and we have or the one that we call continuously compounded return. Okay, now if I have a price. Okay, like for instance, if you want to talk about stock return, before I first talk about price, the price is PT. Okay, when I take the log of the price of a stock at time t divided at the price at time t minus one, that gives us return. Okay, if I want to, return is defined as a function of price, logarithmic. So here I'm talking about the logarithmic return. RT is a return, which is going to be the ratio of the price, the logarithm of the price at time t. Time t may be the current price, then time t minus one is probably the price on the previous day. If I'm talking about day as the unit of time. If I'm talking about month, okay, PT will be the price this month. PT minus one will be the price last month. Okay, depending on the unit of time. Okay, and of course, we can also so the RT, using the Taylor series. Okay, I can also say that guy equal to that, which is approximately that. Okay, and I can also have situation where I want to talk about the additivity of multi-period returns. Okay, at times you could be talking about return from multiple period, not just for a single period. So what I'm just reviewing here is just, okay, you know what, if I have a price, how can we actually determine the returns? And don't forget, the returns are very, very crucial. Okay, so like I said, we have asset return. I think I just give you an example. There's also something that we call excess return. Okay, So, which I'm talking about the short time US Treasury bill, and so on like that. But you know what? I want us to come to portfolio returns because we want to build portfolio. We actually want to have a well formulated portfolio that's actually going to be a linear combination of asset. Take a look at this. I said, suppose one has a portfolio consisting of three different assets. In a portfolio, you're actually going to have a linear combination of assets. And let me tell you this, each asset is going to have a weight. And that very weight is going to be WI. For instance, for asset one, I'm actually investing W1. For asset two, I'm investing W2. And that was why I said here, okay, which is expressed as a percentage of the portfolio value invested in the height assets. Okay, you're actually going to have the total money in a portfolio. Of course, you also going to take into consideration the amount of money you committed, to each asset in the portfolio. And let me tell you this, WIPI is actually going to be the value of a particular portfolio within portfolio. Of course, we can talk about net return. You can talk about log return, depending on whatever return, because in financial analysis, they use different kind of return. It could be net return, just like the same way that you have a gross wages and you have a net wages. Of course, they also have something like that. But you know what we're interested in? I just want to come here now. Take a look at this. This is looking like a weighted where I'm having return from different assets. I put into consideration return from different assets and the amount that I committed to each asset. We don't get return. We have to, four of us, invest before you think about getting return. You get what I mean? So this is like a return of a portfolio now. The ROT here now is talking about the return of the whole portfolio. And don't forget, the portfolio here is a linear combination of the weight and the return from each asset. But you know what? Markowitz puts forward a theory. We don't just put money into different assets arbitrarily. We have to be guided, and you are diversifying, because diversification is like, I don't want to concentrate on just one asset. I actually want to spread my money across different assets. But you don't just spread your money anyhow. You need information, you need to be guided, and of course, if for you to be able to minimize the risk, okay, uh given a particular expected return, then Markowitz, that is why we have a Markowitz portfolio theory. So the Markowitz portfolio theory enable us to minimize risk given the expected return, and at the same time enable us to maximize expected return given a particular level of risk. Okay, and that's exactly what we're going to apply. Now I needed to pay attention. Now I want to go statistical. Needed to pay attention. Take a look at this guy. That's like a portfolio, right? RO is a return that you get from each asset. And don't forget, on each asset, you've already spent an amount of money investing, and what you invest is WI. We want to place a restriction. You know what we want to do right now? We are, oh my God, where am I finding the expectation of R? I want to find what is the expected return from the old portfolio. Then I need expected value of R. Then I need expected value of linear combination. But you know what? Expected value of R is going to be the summation of the weight multiplied. Don't forget, each asset itself is a random variable. Each asset is also going to have its own average. And that is why you see the expectation of the portfolio equal to the summation of the WI and the expectation of the asset. That's what you see now. Okay, now the variance is going to be the variance of R. Okay, and if I want to write that, oh my God, because I'm talking about linear combination. Okay, if I want to talk about the variance of portfolio, of course, I'm actually going to have the addition of the individual variance, the variance of each asset plus the different combination of the covariances. Does that mean saying that is what that guy is trying to talk about? But you know what? What is this guy telling me? That guy is trying to tell me the amount. He said that I put $0. He said I invest $0 on a particular asset, or I invest more than zero. So we don't want negative. That's why you see WI greater or equal to zero. And of course, this guy is trying to say, okay, you know what? I spend the 100%. When maybe I put 10% on this asset, 20% on this asset, but by the time I had or what I put, that would be 100% of my money. Does that make sense? And that's what it means. Summation WI equal to 1. But let me tell you this. I'm still going to walk you through in this class that we can also have situation where WI can be negative and when the summation WI can be greater than 1. And that occur in short selling. Has anybody heard about short selling? The short selling is when you try to borrow an asset and you sell the asset out with the anticipation that the price is going to fall. When the price fall, you buy it back. That is what we call short selling. In the short selling, of course, the WI can be less than zero, can be negative, and of course the sum, because the fact that you borrow, that's not your money. Does that make sense? Okay, and that also come with risk. Okay, now I want you to pay attention now. Do you know that the Markowitz enable us to arrive at an excellent diversification? An excellent diversification is the one that ensures that the assets don't correlate. Okay, and if the assets don't correlate, if they don't move together, if one asset perform poorly, if they correlate, every other asset will perform poorly. We don't want that. If this one perform poorly, okay, you're going to have hope on the other one. You're only going to have hope on the other one if there's no relationship. And that is what Markowitz is trying to achieve. If you take a look at what I have, what is the rule of thumb? Diversification via a portfolio tend to reduce the risk of the risky investment. And how am I going to know I succeeded in doing that? Okay, the real variance, the original variance of the portfolio when you have not applied the Markowitz portfolio theory will be greater. So what we at the end of the day, if you take a look at this is the variance of the portfolio after applying the Markowitz theory. Of course, you can see the other one, like I said, this is going to be less than this. So what we're trying to say in essence, when you diversify, when you follow the Markowitz theory, the variance, you will be able to reduce the risk. And that very risk will be less than the conventional risk when you have not applied Markowitz theory. I'm going to say that again. The variance that we want to reduce is actually this guy. Okay? At the end of the day, after applying Markowitz theorem, that variance of the risk, that variance of the portfolio that we call the risk will be less than the conventional variance. Okay? And that can be achieved through Markowitz theorem. Okay? And let me tell you this. And I said something here. I said to reduce risk through diversification, an investor usually has to settle for lower expected return than those of the riskier assets with high mean returns. When you are focusing on high mean returns, at times the high mean returns come with a higher risk. Okay, so how do we use Markowitz theory? That will be the focus in the next lecture. Of course, in the next lecture, I'm actually going to walk you through the or quadratic optimization, the way McCoy actually, handled that. Before I go, no new assignment for the remainder of the semester, so that you will be able to focus on your project and the final exam. Now, today, I'm actually going to assign, I've seen the list that you sent to me, those of you who have been able to formulate a group. But let me tell you this, if you are not able to formulate a group, I will automatically, by the end of today, put you in a group. And today, I'm also going to put the top, the area you're actually going to work on. And the moment you receive the area, you start your work, because December 1 to 5, there's going to be presentation. You actually need to put somebody forward that will present on behalf of the group, and you let me know if there's a particular person that is not participating in your group. We want situation where everybody is going to participate. We don't do research in isolation. I'm actually introducing you, exposing you to working together. Does that make sense? That's all I got today. Make sure you all stay safe and have a lovely day. Bye for now, everyone.
You're gonna send me email. On that email, you're gonna have a list of somebody in your group, all the member in your group, including your name. Okay. Yeah, you. Yeah, how are you?
Yeah, so I just is this enough information? I don't.
Yep.
Okay.
That's what I need.
Yep.
That includes your name, right?
Yeah, that's include my name.
Yeah,
But
that's
like
all
I
I
sent
need.
it late this morning.
No, that's okay.
Okay,
Because today is the last day that even yesterday was the last day, but today is the day that I'm actually going to be assigning,
perfect.
Yep, topics and stuff like that.
Yep.
You're good.
Okay, thank you
You're
so
good.
much. Yeah.
You're welcome.
Thank you. You have a great
Yeah,
day.
and you too. Yeah.